So welcome to this panel. We'll be speaking about investing for resilience amidst and post-conflict. I'll introduce the panel and then we'll move on to some questions. So to start off with, we've got Bartot van Singeland, managing partner at XSML, a fund manager based in DRC, Uganda and Angola, and expanding to Zambia next year. We've got Paul Uma, partner and co-leader of Africa Advisory at Cross Boundary, an investment company. Natasha Corvinus, principal officer, venture capital at Proparco, the French DFI. And Sebastian Boyer, co-chief executive officer at INP, an impact fund manager. Welcome, everyone. So to start off with, I wanted to start with a bit of a fundamental question, which is, what are the markets we're actually talking about here? Because there's a lot of definitions floating around as area. Sorry, I didn't introduce myself. My name is Alex Kaczarski and I work at British International Investment, but here I'm representing ARIA, which is a DFI initiative to invest more in frontier markets. So as I mentioned, ARIA talks about frontier markets. The panel talks about post-conflict markets. There's talk about fragile, low income. I think there's a lot of definitions floating around. And in the past, history has shown that grouping countries together is not always the best idea. So I wanted to start with Paul. What do you think, what are the markets? What are the common characteristics and differences between the markets that we'll talk about today?
Yeah, sure. Morning, everyone. So I think the way we've kind of looked at markets, and even when we're engaging with development partners and investors, is kind of look at them as kind of underserved markets. I think if you look at kind of the fundamentals, the demand is still there, like the previous panel kind of talked about. The consumer demand is still there. What we kind of find issues with is kind of access to capital and appropriately kind of structured capital. And you just have to kind of apply the different nuances to each of these countries or geographies. In some cases, transactions may close a lot faster than others, given the underlying infrastructure may be there, or even kind of the readiness in terms of the companies to absorb that capital. But you also appreciate that the intensity of support in other markets is needed, and also kind of broader engagement with policy actors to create kind of a more conducive environment. So I think just overall, we as a firm, we've also operated in markets like Mali, we have a presence in Kenya. The challenges can be similar in some cases, but underlying demand and opportunity is still there. So we've always looked at kind of underserved markets as our terminology.
Thank you. And Bartot, from your perspective?
Yeah, I agree with you. I think we prefer the term frontier because it's a more positive way of looking at things in the first place. There is, as said, there's a lack of capital, other resources, but different markets look different, and even within countries there's huge differences. We're operating DRC. Kinshasa hasn't had any major conflict in the last 20 years, yet DRC, because of the east of the country, is seen by some as a post-conflict market. And then we operated initially in Central African Republic, which was post-conflict when we started, and it became conflict afterwards. So where do you put that? Where do you put the name then? So I think frontier is a more captivating way of saying it. And I think the lack of infrastructure, both on the government side and within the private sector, is one of those key elements that need to be addressed in those markets.
Great, thanks. So you mentioned frontier markets as a more exciting, more positive term. And Natasha, I wanted to understand from your perspective, do you see opportunities in these markets? Is there money to be made basically in these markets?
Absolutely, we do see opportunities in these markets. I mean, outside, obviously, that it is a core part of our strategy, especially in the new strategy. I mean, at least 15 to 20% of our invested capital is supposed to go to frontier markets, which obviously includes, for part, the post-conflict or conflict-affected states. In the recent times, we definitely see the opportunities arise. I mean, some of these markets are relatively large as well. So in terms of just size of GDP, size of population, there is really investable companies and funds available. Of course, it requires a certain level of management on the ground, like understanding the situation. We'll speak about that later. But both on the direct as well as on the fund side, we have, for example, last year alone, invested around 145 million in these frontier markets. Interesting opportunities have arisen in segments of the market where you have basic goods and services that the population simply needs. And as said, I think by both Paul and Barthoud, I mean, there will be sizable markets that may, for a part or only a region, be affected by a conflict situation or have a certain level of fragility still in the terms of certain infrastructure just not being present. But that does not mean that the underlying population does not need these goods and services. And as such, we've really seen business cases that have showed a tremendous amount of resilience. And we have also recently seen strategic investors that are happily coming along with DFI investors to seize these opportunities and enter the market. Maybe more in, for example, renewable energies opportunities, but also other types of manufacturing or services for sure.
Great, thanks. And Sebastian, from your perspective, from INP, do you have a successful track record of making investments in these markets? And I also wanted to ask about exits, because that's something everyone thinks about when talking about frontier markets. Are exits possible in these markets?
So yes, on the exit question, I think that if there are some good opportunities in terms of investment, it is clear that liquidity can be a challenge. The good thing about frontier market and opportunities is that usually you don't have a lot of competition when you are making a deal. The bad thing is you don't have a lot of competition when you are exiting the deal. And obviously this needs to be taken into account. So how do we deal with that? We deal with that through structuration. So especially in the most fragile environment or the most frontier environment, we are going to use quasi-equity, mezzanine, self-liquidating investment, where basically your returns are going to come from the company's cash flow. That's a way to solve the issue. And I know that Barthoud has developed quite an impressive track record using also this kind of investment tools. However, depending on the market, depending on the industry, not all companies can withstand cash flow pressure, and sometimes pure equity is needed. And we have a structure, quite a number of investment in this frontier market, also in pure equity. And pure equity allows also leverage, basically being able to secure bank loan or DFI money in the form of loans, and leverage can be good for your returns. So on that, to exit from your pure equity deal, I think you have to follow the golden rule of private equity, even more with more intensity, which is basically think about exit every day, from sourcing, from monitoring your investment. But what I can share is that basically exits are happening in this market. INP over the course of the past 20 years have accumulated now close to 40 successful exits in this market. We have sold our stakes to local investor or the entrepreneur himself for small deals that can be good exit opportunity. And for larger deals, we have sold our stake to financial investor, sometimes philo impact investor. We have recently exited an agro-processing company in Burkina to a fellow impact investor, which is in the room. But sometimes also commercial private equity who are looking for opportunities in market where there are few opportunities, and they like basically opportunities that have been groomed by an institutional investor. And strategic investor also can have some interest for SMEs, even in this market. We have invested in a company in Mali and who extended to West African region and sold it to EDF, which is the French utility company. And we have many other examples. So it is difficult, it can be challenged. You have to be careful about valuation at entry because valuation at exit can be challenging, and you need to be patient.
Great, thank you. And Paul, cross-boundary, you have both an advisory side and investment platforms that help with energy access. And you work across the continent, including in a number of frontier markets. Where do you see opportunities?
Yep, sure. So even just speaking to the area mandate, kind of focused on a few kind of core markets: Liberia, Sierra Leone, Ethiopia, DRC, and the activity that we've seen across those markets, like we've been able to kind of build a pipeline of about 200 companies or businesses that are seeking capital to kind of share with a pool of DFIs. And the opportunities cut across kind of a different spectrum. You're looking at businesses developing industrial parks. Even, we're in a privileged position. There are people trying to build, hotels in these markets while we're kind of freezing in this one right now. So it's just, just trying to appreciate the fact that, these markets also need this infrastructure as well for investors to visit, for deals to happen, but also kind of to tap into a wider supply chain. Food service companies providing, agriculture products to these hotels, service industry, waiters, waitresses, and so on. Others, Alex, like you mentioned, we're seeing a lot of opportunities in the mini-grid space. Companies also applying commercial industrial solar for their operations to kind of mitigate against kind of the downside of kind of the grid. And then even other companies kind of tapping into the kind of export opportunity. And that links back to the whole point about the industrial parks. So as much as, kind of food security is kind of a key theme in many of the geographies we work in, there are also kind of value addition and export opportunities, whether it's in coffee, tea. We've seen kind of an uptick in terms of fertilizer, edible oil, many of which the resources are in these countries. It's more about kind of moving up the value chain in terms of processing.
Great, thank you. So I think all of you spoke about opportunities and there being investments to be made. But I also wanted to talk about risks. I think there's no sugarcoating that frontier markets do present quite unique risks. And how can we manage those, Bartho?
Yeah, I think we see it as there's uncertainty, which you have everywhere in Africa, but maybe in these markets a bit more than elsewhere. There's a lack of information and a lack of resources, particularly human. With the uncertainty side, how we look at it is that there are certain things you can't control. We've had experience in markets where it became a conflict and then you can do anything you like, but you're out for 2 years and then you have to recover. So that's really hard. Gladly, that was only a small part of our first portfolio. On that part, what you then try to do is to really, at least we focus on finding the right promoters, entrepreneurs, because we're not going to carry the can. It's them who have the majority stake in the company, run the company, know best their industry. Our focus is on growth capital, so it's less on really pure startups. So we know they have experience in their markets, and then you build a long-term relationship with them and you stay very close to them. That's another very important component because lack of information, as I mentioned, is something you only can cover by being close to these people and understand what's going on in the market, in their heads. And that's been fairly successful. We've invested in DRC alone in over 40 companies. With the 3 funds, we've raised over 140 million in over 70 companies with about over 100 technical assistance projects. And that's to support these promoters to really help build their business, which then leads to more resilience, improved businesses, etc. So those elements are very important. And then the last bit links back to promoters, but also to our teams, is resources. It's hard to find the right human capital. So then again, if you look at an investment, it's very important to spend time to find the right people to invest in. And you, as I think Sebastian has also seen in the markets EMP is operating in, to find teams locally that can do your type of job is not easy, so that takes time.
But I can also insist on the fact that proximity, especially in this frontier market and complicated market, is key. And local teams are very important. Sometimes even local investors are also important because they bring a local perspective. And that's, I think, something which is really key.
Great, thank you. And
yeah, there was one other thing that I left out, but as Sebastian is saying, it's very important to have cash flow focus. If you wait for a bullet to come in after 5 or 8 years, and it's an equity stake, the risk is much higher. So what we try to do is we do a lot of mezzanine, so it means debt with revenue share, some equity stakes very selectively, always with that, because it gives you a hook in a promoter in case you need to find a way to work together in a more difficult situation. And with that, you do 2 things. It fits well with these type of businesses because they like it, they understand it, it's not too complex, and they don't give away the shop. And for investors, it's very interesting because you start with a fund, you start to give back capital to your investors after 1-2 years. So your DPI creeps up every quarter by doing distributions, and that also helps de-risk the exposure our investors have. And of course, for us, the derived side is that because of doing that with our promoters and our companies, we also see our risk going down.
great, thanks. And Sebastian, I wanted to speak about impact strategies. What are the special considerations in these frontier markets around impact strategies? And Paul, for example, mentioned a hotel. So, let's assume a 5-star hotel in Sierra Leone. Would that be inherently impactful because of the kind of effect it has on the market, or would you have to consider it differently as per your impact mandate?
So I think what is clear is that it is very important to have an impact mindset to be targeting specifically these frontier markets. We have talked about the challenges in operating in this market, on liquidity, on risk management. I would like to add something which is size. Basically, if you want to be relevant in this market, you have to look and meet the entrepreneur where they are. And where they are is usually that they are still small businesses. If you are coming with a 10 million investment ticket size, you are not going to be able to make a lot of deals in Burkina Faso, for instance. You need to adapt your investment capacity to this market, and that means being able to make investment as low as a few €100,000, 1 million, 2 million euros. And where I link that to impact and impact mindset is that obviously working with smaller companies is more complicated because these companies are more fragile, and it's more complicated also in terms of fund returns, GP business model, and so on. So I think having this impact mindset is key. And so to come back to the question of the hotel, another way to ask the same question is, any investment in this market are impactful or not? I believe in a certain, I believe it is the case. I believe that investing in SMEs, even in a 5-star hotel, has an impact through the jobs, but also through the proof that you can invest in this market. Now, as far as INP is concerned, and every investor has its own strategy around that, we have an impact framework which is quite quite developed, and we have KPIs we need to meet in terms of returns, but also in terms of impact. So when we are going to build our portfolio, we are going to look at objective on women entrepreneur, about job creation, about essential goods and services, and therefore our impact strategy, our investment strategy is going to be able to meet all these criteria. So why not an hotel, five-star hotel in Sierra Leone, if it's creating a lot of jobs, if it created and founded by a woman entrepreneur, can be part of this impact strategy, all together within a portfolio.
Great, thanks. And actually, in the case of the five-star hotel in Leone, that's also a reason why airlines don't go to Freetown, because there's nowhere for the crews to stay. So I think that's important to kind of understand the specifics. Natasha, I wanted to understand, you're an LP at Proparco. What do you think are the qualities fund managers need to possess in order to make successful investors in these markets? And reversely, as LPs, what's a good mix of LPs to support these fund managers?
Starting with the GPs that we look at, obviously, I mean, it's said before, like local presence is key. It's really key that these are people that have been operating in these markets in whatever capacity, ideally, obviously, an investment track record. But at the very least, like really understand those markets are present, are close to the investees that they target, because we just we know that it is harder to like find valuable deal flow. You have to be closer to the entrepreneur also to know who is who. In terms of risk, we haven't talked about, obviously, enhanced KYC risk, risk of terrorism financing, stuff like that. ENS needs to be properly managed. So we want someone that really understands the context. I think then on a larger scale, like we need to like see a fund that either is diversified across several markets, depending obviously the size of the more frontier markets that they are targeting underneath. And then see the scale of the team, because we know that these type of investments just require much more hand-holding. And then you obviously have to look at risk return and understand that in some of these instances you're gaining something on the impact side, but you might not have the steep returns that you might expect into other markets. But this is really very different on a case by case, and it doesn't necessarily go hand in hand. And I think we've seen successful, obviously, cases in single markets even, that are considered frontier fragile, so that is great. And then your question on the LP side, ideally, of course, as DFIs, I mean, there will be one or two of us that can play a certain role, maybe with a first loss facility, blended capital, to also draw private investors over the line. At Proparco, we have some of these facilities, either French state or EU funded, that can provide a certain level of first loss and de-risking for the group of LPs. And then I think from understanding the markets, like ideally the LPs are also able to understand that this is not a one-size-fits-all model, that you have to help the fund management manager sometimes to translate certain investment requirements towards like maybe the context that they are daily operating in, and thereby you also make that fund ultimately more investable for maybe in a second fund or a third fund for private investors.
Thanks. And Bart, you guys are raising for your fourth fund. How do you sell yourself to LPs? What's the value proposition that you bring in these markets to make yourself attractive to LPs?
Yeah, it's not much different from how we started 13 years ago. I think it's by showing the right product, and it goes back to what Sebastian and Natasha were saying. What is important is that it's something that there's returns being made, so track record, performance, and link that back to what we're doing in these local markets. So, which is being close to, and I'm not going to repeat the things that have already been said, but it's being close to these entrepreneurs with the right product, and build a culture in our team where we know, because it's at the end for us, it's also about sustainability from a fund manager perspective, which means that the funds, you can't only do the five-star hotel or a larger client, you need to do smaller ones too. You create a mix, and part of that portfolio is more steady returns and others need more hand-holding. And that overall leads to an overall portfolio that is something that investors at the end are interested in investing in a fund like the ones we run.
Great, thank you. So I'll open up for questions. We've got about 4 minutes left. The iPad also doesn't like my face, so maybe we can go the traditional way. And if anyone has any questions, if you could raise your hand.
There must be one.
Any questions? Oh, yeah, sorry.
The premise of the talk was investing for resilience. What does resilience mean to each of you when you think about your investments, and is resilience for who as well?
I can do a quick one if you will. I think resilience, I see it again in our promoters. It's the local business leaders or people that have their businesses that are, if you compare it to being in other parts of the world, particularly in the West, I find them much more inspirational as promoters because we hardly talk about a number of things that are talked about a lot in other places because it's part and parcel of what you do. There may be a flooding, or there may be the electricity may not work, or there may be tax. The tax people who come in who you need to deal with. There's a whole range of things that you need to deal with as an entrepreneur, and the ones that are surviving are the people that are street smart enough and can grow a business despite that. If you don't have those things that make your life hard, these countries would grow, their GDP would grow much faster, those businesses would grow much faster, and yet you get to, even with that, you get to in the teens of growth percentages per year. And that for me is resilience. And with that come that you can have more people in, that you create jobs for, etc.
Paul?
Yeah, and I cannot agree more. If you are not ready for crisis management, then it's not a good place to invest. And there are good entrepreneurs that know how to deal with that. But I think also resilience is about what SME can bring to a local country, to a local economy. When you are basically, transforming maize locally rather than exporting it and then importing it, transformed, then you are in Burkina Faso, you are making the country more resilient to political crisis, more resilient to borders being closed because of a political situation, and you are able to transform locally. And I think the role of SMEs in building resilience within the economy is also a very important element.
Great. Thank you so much. Thank you everyone for listening. Our time is up.